Hi, my name is Nathan Dean, and I'm a senior policy analyst with Bloomberg Intelligence. Today, I'm here to talk to you about the 2022 key trends for the U.S. policy space for the financial services industry. But before I do that, let me discuss two key tools that are available for you on the Bloomberg terminal that we think will assist you when you are trying to identify policy risk. The first is Bloomberg Intelligence's policy dashboard located at BI-PLCY Go. Again, this is BI-PLCY Go. Now, this dashboard contains our curated research for the subjects that are most topical for today's markets. This could be climate change, Federal Reserve leadership changes, or President Biden's infrastructure plans. The dashboard also contains what is known as Bloomberg Intelligence's policy matrix. Now, this is a matrix that is designed to allow you to search by company for the policies that are most relevant today. So, for example, if I wanted to see what is most relevant for Bank of America, I search for Bank of America and I see the policies and whether or not these regulations or legislations or other types of orders are material. And I also see what's the odds of probability, the timing, and the passage expectancy, et cetera. So if you have any questions, all of this is located at BI-PLCY Go, or feel free to reach out and I'll be happy to help you with that. So let's just talk about the trends for this year. Now, for the US financial regulatory space, it's being dominated by cryptocurrency. Now, cryptocurrency is still in its infant stages when it comes to regulations. There are a handful of regulators that are looking at it, including the SEC, the CFTC, the CFPB, and the FSOC. But what they are doing is relying on existing authorities to do so. So if you're at the SEC, you're looking at items that you think may be securities. If you're at the CFTC, you have jurisdiction over the derivative markets. But there are gaps out there. The spot markets, for example, aren't regulated at all. And so Congress has been dealt a lot of pressure to come up with a new cryptocurrency regulatory regime, but I just don't think they're going to get there in 2022. There's certainly a lot of discussions taking place and there's legislation being proposed, but 2023 after the election is more likely than not when Congress will actually begin to pass broad sweeping cryptocurrency rules. So until then, it's going to be this piecemeal regulation by existing authority. The second biggest trend that we're going to see is a new and enhanced view on consumer finance. Now, this is the Consumer Financial Protection Bureau. Now, these are entities, whether you're a bank or a payday lender or a debt collector, if you have a consumer-facing financial arm, more likely than not, you're going to be under the CFPB's jurisdiction. Now, for larger companies like the banks or maybe some of the larger publicly traded payday lenders or debt collectors, this actually may be a manageable risk. Because what the CFPB is doing is they are going to increase disclosures, they're going to increase customer transparency, and they're going to increase compliance regulatory burdens. And if you're a publicly traded company or a large privately held country, chances are you have the ability to spend additional funds to deal with that threat. In many of these industries, there are a lot of small privately held players. And one of the instances we see of the CFPB coming in with a heavier lift, if you will, is that smaller players may actually be pushed out of the market, offering up the potential for market share gains. So it's a mixed sword here with the CFPB, and it really depends on what is the company's position in that space. The next thing we're going to talk about is banks. So we have new leadership at the Federal Reserve. Jerome Powell and Sarah Bloom Raskin have been nominated by President Biden to be the next Fed chair, or renominated as the Fed chair, and the next Fed vice chair of supervision. And there's really two areas of focus that we think are important for 2022 and 2023. With the caveat is that not much is going to happen this year. The majority of it will happen in 2023. Now, this is climate change and capital. So climate change, there's been a lot of focus on climate change. Essentially, the story that you need to know is that the Federal Reserve is going to work with the banking industry rather than dictating to the banking industry how to identify climate risk. Now, this could be transition risk, it could be physical risk, et cetera, but they're going to work with the industry. And for a lot of, say, the regionals and the large banks, they're already doing this type of work. So I don't see it as much of a burden. And when it comes to capital, there's going to be lots of talk, especially if the U.S. economy begins to sour and risk goes up, on whether or not banks are adequately prepared for that in terms of their capital requirements. But again, I don't see anything changing this year. I see it happening if it does next year. And so 2022 will be a year of analysis, a year of study, And we'll have to see how the economic situation plays out into 2023 on whether or not capital is going to be impacted. So the final thing I wanted to talk about are the exchanges, both the equity and derivative side, as well as asset managers. Now, for the exchanges, essentially, there's not much happening at all. There is some, work being done at the SEC on equity exchanges, for example, in terms of market structure. But we think the exchanges are pretty well prepared to deal with that. And even broker dealers, for example, the larger ones that are publicly traded are probably adequately prepared to deal with this. These can include digital engagement practices, responses to the market volatility for GameStop and AMC and other meme stocks, for example. But again, we think the exchanges are well prepared for that. On the derivative side, honestly, there's not that much happening in 2022, so I would doubt that we would even write much about it this year. Finally, for the asset management industry, this is all about disclosures, transparencies, et cetera. So the SEC has already put out a couple of proposals on hedge funds and private equity funds. These are proposals that actually have to dictate more transparency about fees. These are, we anticipate another proposal coming out on climate change for, disclosures. When it comes to disclosures and customer transparencies and customer protection rules, just note this. We have yet to ever see a transparency proposal that comes out that is material in impact for a large publicly held asset manager. Most of these proposals that come out are going to be manageable. Sure, they will certainly increase costs, or they may actually change some fee behavior and so forth like that, but we doubt they will be material. And so if I was the CEO or the head trader over a hedge fund, this is something that I would note. But if I was the compliance officer or the chief legal officer, this is something that I would actually be more interested in. So again, when it comes to the asset management industry, lots of proposals out there, lots of headlines, not a lot of material impact. So I know this was quick, but if you do have any questions, please feel free to reach out and I'll be happy to speak with you further. Thank you.